As the old saying goes, when you play with fire, you can get burned. And that's what happened this week, a total meltdown. It was the worst week for the Dow and the Nasdaq since October of 2008, the worst week for the S&P since August 2011, and the worst week for the Russell 2000 since September 2011. The Dow is now down 16% from the recent high. The S&P is down 17% from the recent high. The Nasdaq 100 is down 21% and is now in a bear market. Nasdaq Composite is down 22% and is now in a bear market. And the transports are down 23.6% and are now in a bear market. And lastly, but not least, small caps are down 26% and are now in a bear market. So let's take a look. Before we go to the charts, I wanted to show you this here, which is the CNN Fear and Greed Index. And based on this index, we're now at a level 5, which is, according to CNN, an all-time low. Now, the chart only goes back to 2016, at least as it shows here. So if this is an all-time low, only going back to 2016, it's not that big of a deal. So we'll just take what we see here, and it shows that we're at extreme fear, a level of 5. And looking at the chart on the lower right side, we've been bouncing down in these lower end areas for a few weeks or so, I would imagine. Apparently a little bit lower than we were in early 2018 and maybe even lower than we were in 2016. So we'll take it for face value. We are at an extreme fear level, and I think this week did show some fear in the market. Certainly, we might have started the panic and capitulation. So let's go to the charts now. So we're looking at the 2-year weekly chart on the spiders, closed 240.70 on Friday, and this is the first of two charts we're going to take a quick look at. Now, in the previous update, I drew a trend line from this bottom point here in early 2018 all the way to the current level, and I had said that there was a possibility that if we went below that level, there would be some selling. Well, it is more than a possibility, it's a probability, and now it's actually a fact. So that's what happened this week, is that we went below that previous level, and I think there's a lot of people out there that started to panic. I'm not sure if we have hit the capitulation stage yet, but I think the signs of panic are certainly there. Now, in my humble opinion, this is a time for you to start looking for good deals in the market. And we've talked about that before. I've asked you to save your money. Save your money for these days. Have some dry powder. Now, it's not just these days. I'll think this is going to extend a little bit longer because we are in late December and we're going to have perhaps more selling, which may be offset by some pension fund buying. We'll see. It's going to be an interesting end of the year. So, SPY. And looking here, it looks to be, at least in my opinion, not too bad. And I'll show you another chart to give you a little bit better context on why I say that. Looking down here, though, into the MACD, we certainly had this higher high there at that point, and it was lower here. So the downward trend, perhaps indicating some potential trouble. We did have a point here and a point here where we tried to recover, and then all of a sudden we had this sell-off from that point there. Now looking at the MACD histogram, you can see that we were attempting a consolidation in this area here, and then all of a sudden in late this week we had a lot more selling to create this particularly long red bar at that point there. Moving down to the RSI, we're not quite as weak as we were here. We're at this level here. And again, to me, that's just something that shows that, hey, things aren't as bad as that they really seem. So here the stochastics are going much further below than they did back here. No sign of any turnaround yet, but I think that's going to happen soon enough. Now, this level here that we hit, this red level, is slightly below that, which was in early, again, 2018 in February there. We're not at that point there. So again, in some terms, we're not quite as bad, but that's perhaps splitting hairs at this point here. This is definitely worse than it was early in 2018. We've sawtooth down here a couple of times. So I would imagine we hit 98.65, quite low. I haven't seen that in quite some time. So things are very negative out there, but let me try to cheer you up with this next chart. This is the 12-year weekly chart on the SPY, and this is the second and last chart we're going to look at. And as you can see here, the current move is down toward the 200 EMA at that point there. Now we reached down toward the 200 EMA at that point in early 2016. We didn't make it in 2015, and we did go below in 2011, 2010, and also in 2008 and of course 2009. Moving here, you can see more or less the same with the fast line accelerating down. A big difference between the fast line and the slow line at that level there, only exceeded by that point in late 2008. Moving here, the histogram, we are at a level of 3, negative 3.8. We haven't been this low since here in late 2008. So that's somewhat encouraging to me because we're seeing a lot of fear here, but I think the market is certainly in better condition than it was back in 2008, at least right now, in my humble opinion. It could fall apart at any point in time. There's always that possibility, but right now I don't see the markets breaking down as severely as they did there in late 2008. Moving here into the RSI, we're at a relatively low 24.92, which we are right there. We haven't been this low. We didn't get down there in 2015, but we did in 2011 and certainly here in late 2008. Moving into the stochastics, more or less the same story. We're reaching levels we haven't seen in quite some time. And again, to me, that is somewhat encouraging. And here's some more encouraging news too. So follow this. Here are the volume levels early 2018 and then currently where we are now. Now, there's certainly more negative volume to follow here, but if you go back into 2008 and into 2009, I think the levels of volume in that whole time frame were significantly lower than what we see here so far. At least that's in my opinion, and I can see red and green fairly well. All right, here into the Williams, much the same. I would use this chart, but let's go back up to the RSI. As I've told you before, we need to always have a correction because we need to set the foundation for the next move. So here we've had these different foundations set at these different points in time, and we've been able to move off of them and have a fairly good several years of a market. And I think that's what's happening again, is we're setting up another foundation here so that we're going to be able to move off of that. Not sure exactly when, but I think it's going to be coming in, say, early 2019. And yeah, I know the pundits are telling you otherwise. So to me, follow the charts, follow what you see, follow the proof. Don't follow the words, which are relatively cheap as they come. Now, back up here to the price chart. We may spend some time down here, and I think that's just fine. And we'll see some perhaps more selling at the end of this year, potentially offset by some pension fund buying. They're going to have to be buying here pretty soon. And then into 2019, we're going to have a new market. And I think at that point, we'll probably have set a foundation for an upward move beginning in early 2019. So please stay with this channel, subscribe. We're glad that you are here. And for today, that's ChewDog Charts. Thank you.